Let's kickstart things off. So, ladies and gentlemen, we have a very special guest today, Geoff Lucas from the agency. Geoff and I worked together once upon a time about 10, 11 years ago at McGrath. Geoff's a personal sort of role model of mine. He's mentored me over the years, you could say, in leadership and business management. I was inspired by his leadership and management at McGrath. He's had a great uh, tenure in the real estate industry, but also in other industries, financial services as well. I think he's been 12 years or he was 12 years as the CFO and then COO and then CEO of McGrath, and then a bit over a year now at the agency. So two big groups in Australia. Pleasure to have you on board, Geoff.
Great to be here. Just on that personal and mentoring and friendship as well. One of the great satisfactions that I get from my career, or have got from my career, is seeing young people like you were and still are, that are identifying as great talents and working with them and giving them opportunities and seeing you fulfill your potential. And what you did, even though, and I often say it in business as well, our job as leaders is to recognise that we'd really like everybody to stay here in your organisation forever, but we recognise, particularly with today's generations, that people want some portability. And when you see somebody that wants to go and try something else, as you did, moving from Oxygen Home Loans to go and start your own thing, to give you the best wishes to do that. And then you get the benefit of watching somebody's skills flourish. And that's been a really satisfying thing for me to see what you've done in breaking away. You know, we don't have a mortgage on people's careers forever, but our job as leaders is to make sure that when somebody joins, as you did, and they leave you eventually, that they leave better equipped than when they came, which hopefully you did.
Yeah.
And then the wonderful thing is you took those skills and that base and then grew it and expanded, and it's really satisfying to see that.
Someone just made a comment that they can't quite hear, so maybe bring that mic a bit closer.
Please let me know if we can't still hear me.
I have to say that that humble attitude of yours did resonate with me as a whatever I was, a 22-year-old when I left McGrath, and you said exactly that. As long as you are leaving the world more tooled and leaving this business more tooled and equipped for the world than the day you started, and together we've achieved something, which is a great attitude to have in both the mortgage industry and real estate industry, or any industry really. I do note there's quite a lot of the participants that signed up for this webinar. There was quite a lot of mortgage and real estate professionals. So today we'll try and direct some of this content, not just for our clients and customers, but also the real estate professionals and mortgage professionals out there going through the current climate. So on that note, Geoff, run me through. Right now, you've got a big network you're managing, a network in multiple markets. How big's the network? What's what's happening in the markets you're seeing, and tell us what's going on in your eyes.
Yeah, I say this a lot. It's an absolutely fascinating time now. Probably the most fascinating time in my entire career. There are so many different factors affecting us at the moment: economic, environmental, social. And it's all off the back of, the pandemic and how we change the way that we work and live. There's never been a time of more change, which excites me, because as agents and as brokers and trusted advisors, we're here to try and add value and give confidence to our customers and indeed our teams. And there's no better time to show that value than a time of great change. So you're right, we've got a rapidly expanding team. We're currently 420 agents across Australia, some 600 people in our business total at the moment. We're growing at probably somewhere between 25 and 30% in terms of headcount, revenue, etc. We're in 6 states and territories. We just entered our 6th, which was when we made an acquisition in Tasmania. So it's terrific to be in that beautiful marketplace, which is increasingly attractive. And I mentioned before the pandemic, I think that's opened up different geographies for Australians. And that's one of the benefits, I think, of being in a truly national business. We get to showcase to people all around Australia the different territories.
Mm,
All of the markets move very, very differently. We're seeing at the moment, I mentioned before about a period of rapid change. I mean, just on the East Coast, some 8 to 10 weeks ago only, things were coming along beautifully. There was excessive buyer demand. There was FOMO driving
yeah.
incredible auction results. There was intense competition. It opened for inspections, pre auction bids driving prices. And then all of a sudden, somebody turned the lights off.
Yeah, it changed literally overnight, but I'm a big believer that, that consumer sentiment which changed overnight, for the worse, will also overnight change for the better.
Absolutely. And we haven't pre-discussed this, but I am as well. We may as well go there on sentiment.
Yeah, yeah,
I haven't even touched on the business and
yeah,
the
yeah,
different
yeah.
markets, but we'll get back to that. But because you led in on the sentiment, um, sentiment at the moment has hardly ever been lower. It's currently, and we follow the CBA, smart people in the CBA, the banking sector
Mm,
generally, but Matt Common and Angus Sullivan, the guys that run that bank, are smart guys.
mm,
And they've got a view on the terminal cash rate, for example. It's significantly lower than the financial markets.
mm.
They're sitting kind of at 2.6 to 2.8%. But we're talking about, and we'll talk about that a little bit later. But on sentiment, the last 50 basis points on Tuesday um, probably knocked the stuffing out of any element of positive sentiment. However, as you mentioned, it changes quickly and can spin on a dime. My belief is that's probably the last of the 50 basis point increases that we're going to be seeing.
I definitely would agree.
Human beings are funny, we all know that it will stop at a point,
Mm,
but until there's an indication, a firm data point that says, yes, there's the change, we all kind of think, well, where does this end?
yeah,
And because of that, people are reticent to make long term decisions until they kind of see where it settles. So, my firm belief is in 4 weeks at the October RBA, there will be no more than a 25 basis point increase in the cash rate. It may be less, but I'm thinking at the moment it's probably 25 basis points. At that point, us fallible human beings will say, gosh, it's changed from 50 to 25. And in just 4 weeks, I believe we'll see a significant uptick in consumer sentiment as a
yeah.
result.
I feel like there's already been a slight change in sentiment in the last few weeks compared to just post that election sort of period at the end of last financial year. It was, towards June, July, things just went quiet. People weren't looking at homes. People selling homes couldn't sell them. But already coming into spring, there's definitely been an increase in activity. However, confidence and sentiment still a bit low.
Yeah, and that gets to listings that we're seeing at the moment. We're seeing rather than the traditional spring uplift, we think it will be delayed a little bit until that sentiment shift. And you've seen a little bit of it. We're yet to see it really significantly, but it can change quickly. And as a result, we're seeing not large numbers that you normally see at this point. Yes, it's increasing, but not as strongly as it has in the past.
When you say large numbers of buyers coming through open homes on the
No, I
weekend,
meant in terms of listings, new listings. So
listings.
what you've got is you've got vendors saying, well, the buyers aren't really, they're sitting on their hands
Mm,
because the buyers are saying, well, it's going to be cheaper later on.
mm,
Now there's a flaw in that, isn't there? Because again, they think it's going to be cheap. All of a sudden it can shift and the buying opportunity, and I know we want to discuss whether it's a buyer's market, um, might evaporate very quickly because of
mm.
that change in sentiment. So we're seeing listings not as strong as the uplift has been previously in spring. But I do believe in 4 weeks, when that changes, you'll then see a normal spring market come.
Yeah, and it's funny. There's definitely markets within markets, right? Because in some areas, there's, to your point, very few listings, which then keeps prices buoyant. Because whilst there might be a lot fewer buyers, there's still buyers that have been sitting on the sidelines for years, waiting for an opportunity like this to pounce as such, right?
Yeah, correct. And that's the supply and demand thing, right? I
Mm,
mean, the different markets that we spoke about, we're lucky enough, as I mentioned, to be national. And what we're seeing on the west coast is fascinating at the moment over in Perth because their market didn't run nearly as hard as ours did in
Mm,
terms of price appreciation. And the slowdown that we're seeing and the reduction in price here in the East Coast, we're still seeing a fairly buoyant market over there,
mm,
which is terrific and really interesting. And we were discussing Brisbane before as well.
yeah,
That's, I was there just the beginning part of this week. I was there yesterday and out and about in lots of cranes on the river. People are upbeat, running past you, talking. There's a lot of vibrancy in that market. If you were reading the newspaper, as I was, I
yeah,
still do read papers.
yeah.
Here in Sydney earlier in the week, you'd think the sky's falling in Brisbane.
Yeah, I'm a big believer that people need to stop reading too much newspapers or what they see online and on TV because they're definitely instilling doubt and a form of insecurity in buyers and people transacting at the moment.
Well, the other thing with Queensland, of course, is, and they'll tell you this, and we caught up with a number of developers and obviously a number of our customers and agents, etc., is that they're underpinned for the next decade at least by the forthcoming Olympics there.
Mm.
So very, very positive about that particular market. There might be some instability in the short term, but the very good and strong thematics there.
Well, actually, Geoff has a very similar view to Harry Triggerboff, who I was with yesterday at a property seminar in the city, who was saying the same thing. They're seeing, markets like Brisbane or Queensland as a whole, and Adelaide, and I think WA did get a mention by another one of the panel speakers. They didn't see that same ridiculous growth that other markets like Melbourne and Sydney saw in the last few years. And there's a lot more reason to indicate future growth, mainly things like affordability. A lot of people now working from home and could move to a different state to continue to work. And for the same price that they're getting a three-bedroom apartment in Sydney, they could get a four-bedroom house in Brisbane.
Absolutely. I'm lucky enough, as I said before, to work with this business that we see those markets. And case in point here is what has happened to the young professionals here in Sydney that were priced out of the market here, and they've moved north to, say, the Central Coast.
Mm.
And then the Central Coast has become extremely highly demanded. So you're seeing increase in price there. And we're seeing such a massive gap between those markets and, you know, West Coast, as I say, 5 hours away in an aeroplane, yes, but what's COVID done to us? It said, hey, it's opened up geographies.
Mm.
And so we're seeing, you mentioned cost of living and livability. Perth, I think the statistics I saw were the percentage of income to service a mortgage over here in Sydney is about 51% of
Mm.
income to service a mortgage. WA, or Perth, has the lowest, and it's around 27%.
Wow.
And so young people are seeing that and saying, hey, what is it? It's about quality of life.
See, there's a bit of a fallacy there because some people also talk about Perth being $15 for a beer or $50 for a steak because there's other elements of Perth which are probably more expensive purely by the remoteness of the city. However, then to put a nice roof over your head, you're paying a much lower price.
Correct. And the beer is expensive because it's really good beer over
Yeah,
there.
yeah. So something that you've touched on, sort of interest rates and the forecast of what you're seeing. I think it's worthwhile sharing a screen here and uh, just talking about what we're seeing in. Um, oh, sorry, not sure if I'm doing this correctly, but um, there's a bit of a lag out there with consumers and what they see in their repayments changing compared to RBA announcements. Um, so I'm not sure if people can see that, but we'll talk through it anyway. Um, Essentially, when the RBA increases interest rates, we don't actually see a change in repayments for some time because, firstly, interest rate mortgage repayments, there's interest charged in arrears on mortgage repayments. So, your next repayment is based on interest charged for the previous month. So when the RBA comes out like they did this week and increases interest rates by 50 basis points, usually all the banks take a while to make their announcement on what they're moving and passing on as such. This week they're all quite delayed in doing so as well. And when they do make that announcement, it's not effective immediately. It's normally effective for about 3-4 weeks time, a month's time. Then it's a month after that that you actually feel an increase in interest or in your mortgage repayment. So there's about a 2 month lag. So at the moment, we've seen consecutive increases since May, and we've probably only started seeing those first increases in actual repayments about a month or two ago. So there's probably a 3, 4 month lag before we'll see what's happening right now, and maybe another consecutive increase in October, as Geoff says. I tend to agree. I think we've had the brunt of the aggressive increases,
Mm.
which was the aim of that with the RBA was to put a shock stop on inflation, and decrease consumer spending and inflation as such. Um, Geoff, I think you mentioned you had some comments on this. What are you?
Yeah, and it's true. And again, it's our friends from the Commonwealth Bank, whose views on some of these things I certainly share. And there is a lag. So we talked about consumer sentiment and also, I guess, retail spending. It gets to, or consumer spending, it gets to as well. And so there is a lag of some 3 months. So when you think that through, this has been fairly rapid from a cash rate of 0.1% up to now 2.35%
Mm,
as of Tuesday this week. And so you've seen a series of 50 basis points. Now, the percentage change on that is astronomical to
mm,
what it was. But because it's been so much in such a short period of time, I think the statistic was up until Tuesday's rate increase, only about 25 basis points of the increases, that was the first move from point 0.1 to 0.35, only about 25%, sorry, 0.35% of that cash rate had been felt prior to the change to 2.35. And so that's a significant change coming. Now, the other factor, of course, is that's the variable rate currently. But a lot of people took advantage over the past couple of years of the extremely historically low rates and they fixed. And that, I guess, is the lurking danger that's coming in. And it's not just in 3 or 6 months. Again,
it's
there
a
was
while away. Yeah.
looking again for those of you that some of you might follow my LinkedIn, and I published a couple of charts. Are you going to pull it up?
Yeah, I'm going to
See it.
pull up. Once again, it was our friends at Commonwealth Bank with this data. It was the chief economist Gareth who highlighted that comment you said
There
about
it is
that
down
lag.
there.
Yeah,
Yeah. And
and
so this is really interesting because for those that think, oh yes, the rate increases are now reducing, and perhaps in November we go back to no increase, and sentiment might improve there. But if you have a look at that top chart here, that's actually showing the red columns. It's actually showing the percentage of CBA's fixed rate book. Now, bear in mind that's not the entire market, but CBA speaks for about 25% of the mortgage volume. So it's a
mm,
great indicator, barometer. And you'll see that the highest column there is December 2023. Now, we're in currently September 2022.
so over a year away is when the brunt of these fixed rates will come off into much higher variable rates.
And what will they be? And that is the question. What will they be at that time? If we do, according to our view, if we do have a terminal rate of, say, 2.6%, so that's a 2.35 at the moment, plus another 25 basis points next month at the beginning of October, that's about 2.6% cash rate. That probably translates into somewhere, you're probably the expert here, probably 4.5 to
Spot on,
5%.
yeah. Mid 4% is the average probably borrow rate out there. So for those people on fixed rates, those I'd say emergency fixed rates that were offered through COVID, most of them are about 1.89, 1.99 for anywhere from 2 to 4 years. So their interest is effectively doubling overnight. And for those listeners out there who aren't in front of their screen and seeing this data, it's basically saying about 20% of fixed rate home loans, this is CBA's data, 20%, over 20% will expire in June 23, and then another more like, what's that, closer to 25% in December. So a big chunk of debt out there that is currently fixed in about a year's time will start coming off onto interest rates twice as high. So to your
Just bear in mind on that data that each of those red columns is for the 6 months preceding December. So, and
mm,
then for the June 23, the 6 months preceding that. So, really interesting time, as I mentioned before. There's a closely related chart below that, and this talks about consumer spending. And we, again, those of us that do consume the media, um, we hear that consumer spending is robust. Aggregate consumer spending is robust, perhaps up until Tuesday's rate. When you break that down, and again, CBA has broken that down for expenditure between goods and services. And when you break that down, the chart shows that goods is continuing to increase, and this is only up until July, so it'll be
Hmm.
tapering off now. But there's a significant downturn in the expenditure on services. Now,
Mm,
services are more likely to be more discretionary than goods,
mm,
and so cafes, movies, etc. And so we're seeing that turn down already there. We would expect that aggregate demand or consumption would now, following Tuesday, turn down, and that services downturn was probably a lead indicator, and it gets to sentiment. And I suppose that then leads to the economic question of, well, does the RBA see that there's a potential for recession when consumption starts to really tail off?
mm.
Have they gone too hard, too quickly in dampening demand, which we might see over Christmas, important time for retail spending? It's looking as if it's going to be flat and depressed. And that leads to speculation about what happens in the first quarter and then the first half of next calendar year. And I guess the consensus is that we may be entering a period of some modest rate cuts into the 2023 calendar year.
Yeah, that's already been priced in the futures market, right?
Yeah.
I think the AFR released an article about that uh, about 3 4 weeks ago, saying that we're most likely going to see some cuts on the cash rate toward the tail end of 2023 or early 2024. And interestingly, if you look at the cash rate history of Australia, also the US federal rate history. In the last 25 years, there's been about 3 times where we've seen a real significant increase in the cash rate for various economic reasons at that point in time. One was the GFC, and then it came straight down. But every time that there's been a big increase, the government has needed to then re-stimulate the economy and drop them soon after. So right now, to your point, and this data in front of us, Geoff, um, right now that the aim is this decrease in consumer spending to ease inflation, which they will achieve with these aggressive hikes. It is, making changes in consumer sentiment, and then if they achieve what they want and inflation goes back to that target of, I believe, 2 to 3%, um, overnight they could start decreasing again, right?
And exactly, and that's not a bad thing. They've got to treat inflation. It's funny, isn't it, with inflation? A large component of inflation, certainly my belief, is that it is supply driven
Mm.
rather than demand. And normally you use interest rates as a blunt instrument to impact demand. But
They
a
they
lot of
call that
this,
transitory inflation, so it's not real.
thank you.
Mm.
And so it's a large part of them. When you look at the supply chain, we're seeing lead indicators now that the supply chain is starting to ease. We're seeing a sharp reduction in, for example, the price of semiconductors, and that means that there's more being produced, and a sharp reduction in the price of shipping containers. And so
Mm.
things are starting to move more. You're seeing commodity price reductions. Coffee beans not costing us any less for a cup of coffee at the moment,
Yeah.
now, is it? But you're starting to see these things. So what we're going to see is an improvement in the supply chain, and so that factor will reduce, a reduction in demand, and so almost really clearly an environment where rates will be cut. Now, they're not going back to the emergency levels,
No, definitely not.
but that terminal rate that we speak of, say, we believe 2.6%, financial markets probably factoring in 3.2%. Don't think it'll go that far. 2.6, perhaps that'll come back to somewhere low twos,
Mm.
and you'll have an interest rate environment of somewhere around variables, maybe 375 to 425 kind of thing. Big increase on where people were, but nothing like the sixes that are being spoken about at the moment. And that
Mm.
probably lands us in a reasonable environment, bearing in mind immigration. If we're talking property prices, immigration is now starting to increase again. So Australia, extremely popular destination. So we'll see that start to build. So there'll be more demand. In some of we're lucky enough to be public, and so every 6 months we produce our investor pack, and our financial results. And we spoke about there the level of supply coming on, and there is a chronic shortage in both houses and apartment approvals currently for the demand increase that we're seeing.
Particularly Sydney, right?
Absolutely.
Yeah.
And so those factors are underpinning the long-term demand. I guess the message there is there's a lot of alarmism for those people that do consume the media. And yeah, we will see further price falls in Sydney. We're off about 7.6% from our peak. And some of the really smart people are saying that could be 15 to 20, maybe 25%, depending on where the terminal rate ends. We're seeing actually in some markets that it's already, CoreLogic tells us 7.6 across Sydney, but we're seeing in some markets 15% off from peak. But hey, for the 2 years prior, they accelerated by 40, 45, maybe 50%. And so I guess what I'm preaching there is cool heads and try and look through what you're currently seeing at the moment, because what is now is not going to be in the future.
Yeah, 100%. There's a few things there that we should relate to the past and maybe historical averages as well. So, historically, that cash rate that you're referring to, where it might go back down to, say, that 2% level, that's also historically where it's been the last sort of 10, 15 years as well. So, things are just stabilizing and normalizing as such. The other, I think, interesting point to highlight, you mentioned 7.6 was the decline in property prices, was
Correct, yeah, Sydney, yeah.
7.6. And I think in the GFC in 2008, that's pretty much bang on what the average property price fell by as well. So, yes, there's probably a bit of a lag in the data. You're on the front line of the real estate industry, and you're probably seeing that 10, 15% you mentioned. But there's probably
In some markets.
in some markets, definitely, we're witnessing that too. But there's probably a bit of a lag of that trickling through into CoreLogic data that's next thing all over 60 Minutes and a current affair and whatnot. So I'm personally quite optimistic. I think there's probably only a few percentage points left of a decrease. Equities markets, are already pricing in some future pessimism as such. They might be soon bottoming out, in my opinion. But these windows are always short lived. The going back to what we said at the start of this seminar, the sentiment that changed overnight will change for the better overnight as well. And I think right now, to your point, smart money and certain confident, educated buyers as such who've maybe seen cycles like this before are seeing right now as a good opportunity to jump, right?
Well, it's interesting buyer environment at the moment. What better, you'd expect me to say this, what better environment, because you're not there fighting off the hordes and competing against people. You're actually getting an opportunity to take your time, spend time in a controlled environment to make what is a really significant investment decision. And so that's the perfect environment. Now, will there be further falls? Probably. But should we be, particularly when it comes to homes, should we be really trying to time it and buy at the bottom and sell at the peak? Very difficult.
That's the best probably advice you could say, because I think a lot of people try to do exactly that. They let external factors influence a decision, which is probably irrelevant to those external factors, because the hardest thing to do when finding a home is finding a home that you actually want to buy, right?
Absolutely right. And there's another, investment philosophy that was always drilled into me by my father. Always leave something there for the next person. Don't try and be too smart. Always leave something. So, the thematic at the moment, good environment to be out looking at homes and looking at property. No need to jump immediately, but some good opportunity.
And for some of those professionals that are dialed into today's webinar, the real estate professionals and mortgage professionals, what's your professional advice of how to act in current market conditions? I think how they've previously been acting in a booming market through 2020 and 2021 can't necessarily be the same now, right?
Yeah, that's right. I used the word trusted advisor before. In an environment like this, people are confused, scared, worried, fearful. And they're looking for your people and our people to be giving them some guidance and confidence. So I guess it's, as I said before, cool heads
Mm.
and be there to give considered opinions to those people because they're looking for that.
They're looking for someone that they could trust, right?
Correct.
Yeah, and that's the hard thing to instill in someone, trust. I think your former colleague used to say, John McGrath, I remember this back in the day, that you can do 1,000 things right, but one thing wrong can make everything that you've done right unstuck, right?
How true. How
Mhm.
true. So many learnings from our time there, right?
Yeah,
That was my first participation in the real estate industry there.
well,
And
it,
how blessed am I to have been in an organisation like that to teach me about this industry?
it was a breeding ground for the best real estate agents of New South Wales, if not more. So many great figureheads in real estate started in that McGrath network. It was a beautiful culture to be a part of.
Absolutely.
Lastly, just the one more thing that I know some people have been asking questions about, and once again, our favourite people in the media have always been harping on about, but the borrowing power changes and what that actually is correlating to at the moment. So, for those of you that might not be across this, content as such, which is on the news almost on a night every night at the moment, the every time the cash rate is increased and the subsequent borrower interest rates are increased, that does equate to a decrease in borrowing power, so affordability as such. Um, how much is that actually making a difference? So, for those of you who've got these slides in front of them, from when the cash rate was zero point 0.1 to, let's say, a cash rate of 2.85, so that's a 2.75 increase. You know, across we've got six lenders there. The average borrowing power has gone from about 1.1. Let's say this is on assumptions on the average the data out there. 1.1. Let's say you could have borrowed a zero point 0.1 cash rate is now down to about 850. So it's about a 20% decrease in borrowing power. Um, on the average loan of about $1 million, we're probably seeing now after this week's increase. For those of you who've got the slides in front, we're seeing about a $1,300 increase in mortgage repayments on an average $1 million loan out there in the marketplace. So definitely something, right?
Yeah, it's really interesting you raise that. I was speaking to a colleague just earlier this morning, and he was saying that one of his friends, who's dual profession, one child, two people, full time work, professional couple, their borrowing capacity was $1.5 million in the 0.1% cash rate, and they've currently been assessed at 1.2 million, and they've rolled that forward to look at what might be a terminal rate of say 3%, and where interest rates might be a bit further than where you said there, and that comes down to $850,000. They've gone from 1.5 million down to $850,000 in just a period of less than 12 months.
Mm.
Incredible. And we were seeing some things. Some of the agents here will see this, and they saw it back in the, I guess, the frothy times, if we can call them that, of September, October. We were seeing properties that were, $4 million appraised value, and you would actually hear the dialogue from the buyers saying, "Gosh, we can really," because they found a house that home they loved. We
Hmm.
can actually stretch another $1 million because that's only going to cost us 1%,
Mm.
and we're not able to travel. So our annual holiday, I mean, we're in here instead of spending 50 or 60,000, it's going to cost us $15,000 a year only in interest. We're pushing the price from 4 million to 5 million, and we can fund that for the next 3 or 4 years.
Mm.
That was the mentality. The environment that we're going back into, that Theo and I were just speaking about, where the variable rates may be between 375 and 425, that's a more rational, sustainable market.
Mm.
In a market, say Sydney, where there's always going to be strong demand, and we'll move to a much more stable market.
Mm. And it's sort of relevant to those comments. I know we already touched on this in previous podcasts and webinars, but it's important to highlight that during that low interest rate environment, to your point on spending and people's habits and decisions, a lot of people accumulated. There's some data on this, but a lot of people accumulated a significant amount of savings in their offset accounts against their mortgages through that 2020 and 2021 period. which did then correlate to an increase in consumer spending because they had the money, they couldn't leave the country. They may as well go buy a new car or a new, TV or a dishwasher at, Harvey Norman or JB Hi-Fi. We saw
Winnings appliances.
or Winnings, yeah, Winnings Appliances. We'll give them a mention. We saw both brand new and secondhand cars see 20% inflation in I think that was over the financial year 2021. So, yeah, I think now we're just, normalizing to your point that 3.75 to 4% borrower rate is probably where we've seen rates for the last 5 to 10 years. And I think that's a healthy level for the economy to be able to stand.
Yeah, I think so. And look, there's a lot of criticism about the government and the RBA indeed. And gosh, they were unique times. And I really think yes, some of the money went to inappropriate places, but their job was to distribute it into the economy to provide a buffer.
Mm.
We're paying for that a little bit now because there was QE, quantitative easing, so more money, and we're paying for it now as QT, quantitative tightening. It feels difficult, and there'll be some kind of volatility, but they've done a pretty good job in getting us through that.
I tend to agree. I feel like our government got a lot of grief in how we got through COVID in the last couple of years. But I think that our economy is actually in a good shape. You look at other developed nations like the US and the UK. They're seeing inflation at 10%. They're
Mm.
seeing an increasing rate of unemployment, and they're seeing an increasing rate of homelessness and whatnot, crime. Even if we want to look at the US,
Mm.
where here we've seen a decreasing rate of unemployment. I think in June or July, we got to 3.5 or 3.7% thereabouts. There's a bit of wage growth also out there, not as much as we'd like to see. I personally think that's related to the data because of the big shift in self-employed contractors in the world these days, which don't go into wage growth data. Yeah, I think the only thing that is probably being judged is rates moving sooner than the committed 2024 promise by the RBA, but they didn't count for this
Well, it
inflation.
was also a conditional promise, I think. It was provided that the economic environment does not change materially. And the media are terrific, aren't they? Of picking the headline and not really giving the rest and putting it in its full context.
Exactly. All right. Well, Geoff, thank you so much for coming in, and I'll check if we've got any questions. I think no
Absolute
no
pleasure.
no,
Theo.
no questions as such from anybody. If anyone wants to feel free to ask any questions. No, I think it was just some comments on the audio there. Um, well, Geoff, thank you so much for coming in. We'll share this online for people that missed anything and want to rehash some of that data as well that might not have been shared. It'll be online, both on our platforms and I'm sure the agency's platforms.
And if anybody out there has any questions for me as well, you'll find me at geofflucas@theagency.com.au on email or on my LinkedIn account. Easy to find me. Very happy to share our insights and what we're seeing right now and also into the future. But yeah, great to catch up, Theo.
Thank you. Thanks, Geoff. Likewise. All right. Bye for now.